Congress overseeing the Treasury Department's use of financial assistance funds today heard from a panel that included Nobel Prize-winning economist Joseph Stiglitz on possible changes to financial regulation. This is 2.5 hours.
There we go. The Congressional Oversight Panel has two duties. Our first, to oversee the expenditure of funds from the so-called Troubled Asset Relief Program, requires us to issue monthly reports discussing the management of the $350 billion allocated so far by the Congress to the Treasury Department. But it is the second function that draws us here today. Congress has asked that we deliver in very short order a report, quote, analyzing the current state of the regulatory system and its effectiveness at overseeing the participants in the financial system and protecting consumers and providing recommendations for improvement, including, among others, whether there are any gaps in existing consumer protection. We are grateful to have the assistance of so many thoughtful experts in this task. The last time America faced a financial crisis of greater magnitude was in the 1930s. The policymakers who steered the country out of that dark hour put in place a regulatory architecture that served America for more than half a century. Had those leaders chosen a different path, a path without deposit insurance, without banking regulation, without a Securities and Exchange Commission, we would be a very different country today. Today's policymakers stand at a similarly important point of inflection. The path they take from here will shape this country deep into the 21st century. What we get right may not only save an America that is in danger of losing its economic security, it may also shape a new America that is stronger than ever. But what we get wrong may batter a weakened country, leaving it staggered and vulnerable. We will pay for errors we make here, as will our children and our children's children. Alan Greenspan now tells us the very premise of deregulation was misplaced and that he was surprised by this crisis. George Bush tells us that we must abandon capitalism in order to save it. These leaders make it clear that the old orthodoxies are dead. What they do not make clear is how we go forward. The questions we ask today are ultimately very simple. What went wrong, and how do we make very sure that these problems are not repeated in the future? I appreciate that any problem may have multiple causes, and I fully understand that financial markets have more twists and turns than the back streets of Boston. But underlying the complex maneuvering in the current economic system are some basic truths about how financial institutions failed the American people, and how those whose jobs it was to monitor and to regulate those institutions also failed us. Now, with the country in crisis, the American people must not only bear the broken promises of Wall Street and the regulators who were supposed to hold deception and risk in check, they must also bear the double burden of spending their tax dollars to bail out those who failed. We are not here to discuss regulation as a political issue or regulation as an academic exercise. Regulation is a means to an end, not an end in itself. More importantly, it is a means not just to help the financial system as a whole, but those who give that financial system purpose, American businesses and American families. The stakes on financial regulation have not been higher during our lifetimes. Today we will hear from a variety of experts as they give their perspectives on what went wrong and what can be done to ensure future stability. We have purposely solicited witnesses from a wide range of ideological perspectives and with a broad diversity of prescriptions for our future. On our first panel, we will be joined by Gene Dodaro, the Acting Comptroller General of the Government Accounting Office. Mr. Dodaro will discuss a recent GAO report on regulatory reform He will be accompanied by Richard Hillman and Areese Williams, also with the GAO. Our second panel I will introduce just before they start. With that, I will yield to my colleague, to Jeb Hensarling, Congressman Hensarling, for his opening statement.
Thank you, Madam Chair. We certainly look forward to the testimony of the witnesses. I'm certainly impressed, again, by the variety and expertise that will be brought to this panel. In a city where it's difficult to find consensus, I think there is at least consensus around the idea that we need regulatory reform within our financial markets. But more regulation simply for regulation's sake will probably do more harm than good. Many believe that, or look for opportunities to use the present recession to essentially bootstrap a certain ideological agenda and to thrust that into the body politic. The battle cry is deregulation has caused this recession, only regulation will prevent future recessions. First, I observe in my own estimation, we haven't had significant deregulation in decades. There have been reforms, there have been some modernization. Second, I don't view this as a matter of deregulation versus regulation. Frankly, I think the far more important dichotomy is that between smart regulation and dumb regulation. I think smart regulation will help markets become more competitive. I think smart regulation will effectively police markets for fraud and misrepresentation. I think smart regulation will empower consumers with effective disclosure, perhaps in contrast to voluminous disclosure, so that those consumers can make rational decisions. I think smart regulation will help reduce systemic risk. On the other hand, I think dumb regulation will hamper competitive markets. I think it will stifle innovation that has helped put people into homes that otherwise perhaps would never be able to afford them. I think dumb regulation creates moral hazard, and I think we are unfortunately reaping what has been sown previously as far as dumb regulation is concerned with respect to moral hazard. I think dumb regulation will remove and minimize personal responsibility from the economic equation to the detriment of our society. I think it needlessly would restrict personal freedom. I think dumb regulation is pro-cyclical and ultimately will pass on greater costs than benefits to our consumers in our nation. Now, I have served in Congress. I've had the privilege of serving in Congress for the last 6 years and spent the previous 10 years in private business. I have not observed that regulators are inherently more intelligent than regulatees, nor have I concluded that regulatory institutions are any more infallible than private businesses and private institutions. For example, if regulators are so wise, why did IndyMac fail? Why did we have the S&L debacle of the early to mid-'80s? And in fact, there appears now to be general agreement among most economic historians that the Great Depression would have been a garden variety recession had it not been for grievous public policy errors in monetary policy, trade policy, and tax policy. And so additionally, I would observe that those who are proposing even more restrictive regulatory proposals as a cure to our woes, that many of the proposals that are being proffered already appear in the EU among certain other industrialized nations, and yet they have not seemed to be insulated from the economic woes that befall our nation at this time. To state the obvious, families are struggling in this economy. They need help. They need public policies that help preserve and grow their job opportunities. They need public policies that increase their take-home pay so they can meet their mortgage payments, their health care payments. And they need public policies that don't send the bill for all of this to their children and their grandchildren. And finally, to the business of this panel, they need reform and modernized capital markets regulation. In that regard, I think the recommendations that we make to Congress will be very, very important. We must examine all the but-for causes, all the contributing causes to our economic turmoil, and make sure that we make smart regulatory recommendations. And be careful that as we make these recommendations, that we are not simply solving the problem of this recession and laying the groundwork for an even greater recession to befall us in the years to come. We all must be mindful of the Hippocratic Oath, first do no harm, and it is my hope that our panel will do more good than harm with our regulatory recommendations. With that, Madam Chair, again, I thank you, and I yield back the balance of my time.
Thank you, Congressman. The chair recognizes Damon Silvers.
Yes, good morning, and thank you, Chairman Warren. Today, the Congressional Oversight Panel takes up its mandate to examine reforms that will strengthen our financial regulatory system and protect our nation from a repeat of the current financial crisis or a worse version of it. I am profoundly grateful to the witnesses and the staff for bringing this hearing together on such short notice and in such an effective manner. Several themes have emerged already in relation to needed reform, both involving from the crisis we have experienced so far, themes involving both regulatory substance and regulatory structure. We also face a number of complex dilemmas, again, involving both regulatory form and regulatory substance and regulatory structure. I'm certain today's extremely distinguished panels will help us formulate specific policy responses to weaknesses in our regulatory system and help us think through those more difficult conceptual problems that have been brought into focus by the financial crisis. As we begin this hearing, let us keep in mind that financial markets are not ends in themselves, nor do they exist to make market intermediaries wealthy. Their purpose, the purpose of financial markets, is to facilitate the transformation of savings into profitable investment, to allocate our society's resources to productive purposes. When regulatory systems fail, when financial markets and financial institutions become manufacturers of bubbles and Ponzi schemes of one kind or another, then our wealth as a society is dissipated and our society's needs go unmet. With that in mind, I think we have already learned some lessons of the financial crisis. First, we as a nation cannot continue a Swiss cheese regulatory system. As President-elect Obama has said, and I quote, "We must regulate financial institutions based on what they do, not what they are." We must bring the shadow markets and shadow institutions into the light of disclosure and accountability. Second, we must abandon the idea that sophisticated parties should be allowed to act in financial markets without any regulatory oversight. Big, sophisticated, and yet reckless financial actors have done a lot of damage to our financial system and to our economy. Third, we need strong, independent regulators, not weak, compromised regulators. Some of this comes down to leadership, which cannot be legislated, but some of it comes down to structure and mission. If we say we don't want, quote, enforcement-oriented regulators, we should not be surprised when our laws go unenforced. Fourth, effective financial regulation is made up of several distinct objectives. We need a regulatory system that facilitates transparency and accountability, that polices safety and soundness when there are public guarantees or systemic risk in play, and that protects the vast majority of us who are neither expert nor powerful when we seek financial services. We should learn the lesson of having asked the Federal Reserve, a self-regulatory body, to both protect homeowners in the mortgage market and ensure the safety and soundness of bank holding companies. We ended up achieving neither goal. Not every regulator can serve every regulatory function, and some functions are in tension with each other. And now for some challenges. What do we do about financial institutions that are both commercial and investment banks and currently receive implicit federal guarantees covering their entire businesses? Do we break them up? How do we address this? Do we try to withdraw the implicit guarantee? Do we regulate their entire businesses like they were all just commercial banks? Do we charge risk-based premiums for each line of business? This is a genuine dilemma. The answer is not obvious. Some have suggested that somewhat technical developments in finance, such as the rise of mark-to-market accounting, the widespread availability of short selling, and the prevalence of multi-layered securitizations significantly contributed to the financial crisis. What each of these developments has in common is that they appear to make financial institutions more responsive to and integrated with financial markets. Is this a good thing or a bad thing? To what extent should these developments be limited or reversed? Can they be reversed even if we wanted to? Finally, we have globalized financial markets. How do we set a global regulatory floor? The answer to that question, again, is not obvious. I am looking forward to an in-depth examination of these and other issues today. Thank you.
Thank you, Mr. Silvers. Senator Sununu.
Thank you very much, Madam Chair, and good morning to all of our witnesses. There are a few goals that I think ought to come out of a hearing like this, and I appreciate those that are attending today for being here. It's very important because, first and foremost, whether you're a panelist or a member of Congress, you can't possibly be an expert in all these areas. So first and foremost, I hope that our witnesses today will help us understand how we got to this point, help us understand the inherent weaknesses in the structure of our regulatory system, but maybe equally important, some of the weaknesses in the operation of that system. You can have a good system of regulation, good rules and laws in place, good organizational structure, but let's face it, regulators themselves can fail to identify trends, can fail to see problems, can fail to exercise due diligence. So structure is important, but the operation of those systems are equally important. And then finally, human behavior. Understand how the market behavior, human behavior, help drive or create some of the problems we've seen both in the real estate markets, the securities market, and in the oversight of those markets. Second, I think our panelists today can really help us understand the complexity of our financial services regulatory system. And I don't think this can be overemphasized. Our system, by and large, was created in increments, successively. Many different pieces of legislation, not over a few years, but over many decades. Many of the elements of our financial services regulatory system date to the 1930s and 1940s. And that means, by definition, that they were not designed expressly for the modern financial services system that we see today. I think we need to look hard and carefully at that complexity, because whether complexity can create gaps, complexity can create duplication, and either can have significant unintended consequences. And as a result of the complexity, I think it's fair to say that the financial services regulatory system is not well understood by many members of Congress, especially those that don't sit on the committees that oversee or have responsibility for this regulatory system. But we are in a position, given our structure of government, that those members of Congress will be responsible for acting on the recommendations of this panel, acting on the various recommendations that are put forward in public by our panelists today. We need to understand that complexity. And as an example of the incremental way in which our regulatory structure is created, we don't have to go back any farther than the well-publicized financial scandals, 2000, 2001, 2002, and the response to that, which was Sarbanes-Oxley. It was a well-intentioned piece of legislation. There are many elements in that legislation that are probably of value, but it is clear that that attempt at regulatory reform driven by contemporary events did little or nothing to forestall the crisis that we're dealing with today. So a process of incremental revision has not served us very well in the United States. And then finally, I'd encourage our panelists to be specific. The legislative process is about as far removed from academia as you can get. That doesn't mean we shouldn't be informed by both theory and ideas that come from an academic source. But we have to deal with the hand that we've been dealt, which is the current regulatory infrastructure, and we need to work from that to one that works better for all the shareholders and participants. So we need to be practical, we need to be specific, and of course we need to work in a very diligent way, because these are issues that the panel is going to be addressing in the coming weeks and these are issues that the Congress will be dealing with extensively in the months ahead. Thank you very much.
Thank you. Thank you, Senator. Oops. Thank you, Senator. Mr. Neiman?
Good morning. I thank all the witnesses for being here today. We are at an exceptional moment in our nation's history where the financial system is at greater risk than any point in the past 100 years. The strain has revealed significant underlying weaknesses in the existing supervisory system, not only in the U.S., but worldwide. While regulatory reform is an ongoing process, I believe that there are 4 key areas to include in any immediate action plan. I base this on a broad range of experience over my last 30 years, having started as an attorney at the OCC, as an attorney within financial institutions, as an executive, as well as a regulatory consultant and compliance consultant, and now, for the last 2 years, as a state bank supervisor. I welcome your views on the wide range of issues, but I am especially interested in your recommendations in 4 key areas. First, on consumer protection. In fulfilling our consumer protection responsibilities, our top priority must be to address the subprime mortgage defaults and foreclosures that triggered the current market turmoil and harmed so many homeowners, neighborhoods, and economies. Second, the role of the states. As the business of banking institutions has become more national in scope, they often complain that it is burdensome to comply with consumer protection regulations in 50 different states. Federal regulators of banks, thrifts, and credit unions therefore have preempted the consumer protection rules of the states, who sounded the early warning on predatory lending. Preemption issues remain a major concern. Third, there are gaps in regulatory coverage, both structurally at the agency level, but also institutionally at the institution level as well as the product level. And fourth, systemic risk. I believe that it is crucial at this stage that we develop a better mechanism for controlling systemic risk across the diverse players in financial services industry. We want to encourage innovation that has long given the U.S. an economy that is second to none. But we need to strengthen our regulatory tools by making sure that all market participants whose failure would pose risks to the broader financial system are subject to supervision. These issues of regulatory reform affect us all because instability in the financial markets affects the broader economy. As we have seen in the past few months, financial market instability jeopardizes retirement savings, access to consumer credit and student loans, and the financing of businesses large and small, the revenues of state and local governments, and the fiscal condition of the nation. Now, as much as many of us agree that this is the right time in our nation's history to address regulatory reform, we must also acknowledge that there is no perfect regulatory model. We only have to look to the many nations in the world that adopt different regulatory schemes and recognize that none of those jurisdictions were spared a crisis or problem. Therefore, in addition to restructuring our regulatory architecture, we need to have more effective regulations and more effective supervision. I believe that the power of this panel really is because we bring together a broad expertise across with different backgrounds, across different ideological viewpoints, as well as political parties. The power is also in being able to call out experts like yourselves in a broad input for external input from academics, from industry, and from the public. But I think the greatest power of this panel, because of that diversity in what we bring to this panel, is to the extent that we can reach consensus on these important issues of the day. And I think that will be very, very meaningful to Congress in their task to us. So again, I thank you all for being here today, and I look forward to your testimony and questions.
Thank you, Mr. Neiman. We begin then with Mr. Dodaro. I want to thank you again, Acting Comptroller, for being here and for coming to talk with us about your regulatory reform report. And thank you again, Ms. Williams and Mr. Hillman, for being with us. Mr. Dodaro, I'd like to start with your opening statement. Your entire statement will be in the record, of course, so if you would hold your oral remarks to 5 minutes, we'd be grateful.
Good morning, Chair Warren, members of the Congressional Oversight Panel. We are very pleased to be here today to assist your deliberations on the financial regulatory system. As you mentioned, we issued a report last week. In that report, we traced the evolution of the financial regulatory system over the last 150 years to lay out and make sure everybody understood the incremental nature, as Mr. Sununu mentioned in his opening comments, to that system. We also outline developments in the financial markets and institutions that have challenged that regulatory system in the past several decades, and we lay forth for your consideration, I think it's very relevant to your deliberations, a framework for crafting and evaluating proposals to modernize the financial regulatory system structure going forward. Our basic conclusion was that the current financial regulatory structure is outdated, fragmented, and not well suited to the 21st century challenges. There are many issues that we point to in our report as to the basis for our conclusion there. I'll mention three this morning. First, regulators have struggled and often failed to mitigate the systemic risk of large, interconnected financial conglomerates or to effectively ensure that they manage adequately their own risk. Second, there have been the emergence of several institutions and entities that are less regulated and have posed challenges to the system. These include non-bank mortgage lenders, hedge funds, and credit agencies. Lastly, there have been an array of products put forth on the market that are very complex and have challenged both consumers and investors and the regulators going forward. Here I would refer to the credit default swaps, the collateralized debt obligations, various mortgage products that have been put forward, as well as over-the-counter derivatives, all of which have been less regulated than many aspects of the commercial banking sector. Now, moving forward and trying to address these vulnerabilities is a complex task that needs to be deliberated on and taken with care to make sure there aren't unintended consequences of moving forward, as well as preserving the inherent benefits of our current financial regulatory system, the capital formation and economic growth over a period of time. So there needs to be a balance, and here we need to strive as a nation to achieve that balance going forward. To assist in this deliberation, we put forth a framework for consideration so that it can be looked at as a system and not in making piecemeal changes to it. We list 9 characteristics that need to be considered. I'll mention a few critical ones here. First, there needs to be clear, explicit goals for the regulatory system set in statute to provide consistent guidance over time. There needs to be, reform needs to be comprehensive. It needs to address some of these regulatory gaps, both in institutions and products going forward. Systemic-wide issues is another characteristic. No one regulator right now is charged with looking at risk across the entire system. To monitor that, to provide alerts, to deal with it in advance going forward. That's an issue that we believe needs attention. The system needs to be flexible and adaptable. In this case, you need to make sure that innovation is still permitted while managing risk going forward so that we maintain the benefits of the innovation of the system. It needs to be efficient. We need to look at the overlapping nature of some of the regulatory organizations that have been put in place in time and make it more streamlined and efficient going forward. We need to look at consumer protections again. Disclosures are very important, as well as financial literacy issues and other key factors that should be part of the overall approach here going forward. The independence of the regulators is another very important characteristic to make sure that they're funded, they're resourced, and they have proper statutory independence to be able to do what's necessary. And we need to protect the taxpayers. We need to deal with moral hazards approaches and provide safeguards in place so that the risk, if they occur, are borne by the industry and not by the taxpayers going forward. We'll be happy to answer your questions at this time. And again, thank you for inviting us to be here.
Thank you, Mr. Dodaro. Really appreciate it. Thank you, and thank the GAO for your thoughtful and detailed report. I read it with great interest and had some very good ideas in it. If I can, I want to focus on one in particular to get us started with our questions today, and that is you highlight in your report how consumer and investor protection has been distributed across a range of agencies at the federal level, federal and state, that there are many actors who have some small part of consumer regulation, and that I believe, as you put it, one of the consequences of this is it creates a low priority for many of those agencies who have other responsibilities and has made for ineffective regulation in this area. You suggest in your report that one agency devoted to consumer financial issues, who would be responsible to the President and to Congress and to the American people, might be a solution to this problem. Can you say more on the consumer side about how one agency, that would be a very different way to look at this problem, how it might solve some of the problems that you have identified?
Well, first, our work has shown over a period of time that this is an area where, while there are some benefits to having multiple people involved looking at this, and I think this is one area where having the state involvement as well as the federal involvement, to go to Mr. Neiman's opening comment, is a positive development, but there needs to be a better overall structure in place across the federal departments and agencies to be able to deal with this. I'll ask Rick to elaborate on our work a bit. We don't actually, make a recommendation that this be done, but we think it has merit, a lot of merit, that should be explored going forward. Our work has consistently shown, whether we're looking at credit cards, mutual fund fees, or others, that the disclosures to the public aren't clear. They don't really understand these issues. Clearly, this was an issue with the various mortgage products that were put forth on the market going forward. We've done work saying that the Committee on Financial Literacy that's set up at the federal level doesn't have a strategic plan, isn't funded properly to continue to provide education in this field as well. So it has a lot of dimensions. Oftentimes it doesn't get as much attention, as we point out in our report, as necessary. So making it a clear priority, setting up a structure, again, in this overall framework going forward, I think is a worthy area to be very carefully explored as this panel and then the Congress goes forward.
Mr. Hillman, would you like to add to that?
Yes, I think that the comments that you made are right on target from the standpoint that the consumer protections are really as fragmented as our regulatory system is currently fragmented, and that can cause for inconsistencies, overlaps, and gaps in ensuring that consumers are best protected. And this current crisis, with what has been taking place with the subprime mortgage market and other areas, has clearly demonstrated that there needs to be improvements in the consumer protection area. Moving more towards a single regulator to oversee consumer protection areas is definitely an idea that merits additional attention. There are many options with which to establish a new regulatory structure. Moving towards a single regulator or moving towards what is referred to as regulation by objective, or a Twin Peaks model, where you have a safety and soundness regulator and a consumer protection regulator, both afford you opportunities to enhance the visibility of consumer protection issues in a reformed regulatory structure. So we believe, as a result of our work, that is a serious issue that needs to be debated to determine how best to ensure consumer protections are delivered in the most effective means.
Thank you. I'm going to switch areas just because our time is very limited and ask, you focused, I thought very helpfully in the report, on the importance of identifying and regulating systemic risk. Obviously a terrible problem right now. And others have also talked about this, Chairman Frank, the Treasury Department. Can I ask you to comment just briefly on the question, your view about whether the appropriate entity to identify and regulate systemic risk is placed with the Fed or with a new regulatory body, a new regulator, to look specifically at systemic risk? Could you have a comment on that, please?
Yeah, there's various trade-offs associated with making that decision. Obviously, the Federal Reserve's focus on monetary policy is important, and to maintain their independence in that regard. One of the areas that we've looked at over the past is how some other countries have handled this particular issue. The United Kingdom, in particular, went to a single financial services authority, a single regulator, while maintaining the central bank functions. And given the current situation, they were, reevaluating some of those issues. Part of the issue there is how much the central bank really needs to know about what's going on within the financial institutions around the countries to put them in an informed policy-making position. So this is an area we don't have a ready answer for you today, but I think it's an area that needs to be carefully considered going forward in the debate because there are some serious trade-offs associated with providing all of these type of authorities to one entity.
Thank you. I appreciate it. And I'm out of time. Congressman?
Thank you, Madam Chair. Mr. Dodaro, thank you for appearing here today, and thank you again for the quality of the work of the GAO. I find the reports to be helpful, comprehensive. In the report that I have before me, there is a short discussion, I guess, of our history of our financial regulatory system, a number of observations you have for the framework for this panel and Congress and other policymakers going forward. What I don't necessarily see, though, is an analysis from GAO on the significant but-for factors that has led us to the economic turmoil that we see today. I think we're all the believers of the adage that those who do not learn the lessons of history are condemned to repeat them. So am I missing that from this work? Was that not in the scope of the work, or has GAO come to some conclusions about the primary but-for causes of our present economic turmoil?
Well, the report does focus on some of the developments that have happened in the financial marketplace that have challenged the regulators, but it is not within the scope of it to talk about all the underlying economic situations that have gone before that. I'd ask if my colleague, Ms. Williams, could elaborate on that.
No, I think it's accurate that we did not specifically set out in this report to lay out the reasons for the current economic turmoil in the market. We simply use this as an additional data point in addition to other problems that have existed in the markets over several decades to illustrate this is yet another example that points to serious questions about the regulatory structure.
In dealing with the issue of consumer protection, on page 18 of your report, you state many consumers that received loans in the last few years did not understand the risk associated with taking out their loans. After first being elected as a member of Congress, my wife and I purchased what we refer to as an old, expensive condominium in the Alexandria area. My 5- and 6-year-old refer to it as the itty-bitty teeny tiny house. When faced with the real estate closure of that condominium, I remember being given a voluminous amount of documents, almost none of which I've read, notwithstanding the fact that I actually had a short and illustrious legal career and had to read that stuff at one time. I remember asking the real estate agent who actually reads this stuff, and the answer was about 1 out of 100 home purchasers. I said, well, who's the one? And they stated a first-year law student at one of the local law schools. My question is, should consumers know what mortgage products that they sign, and can they know? Is there a concept is it possible for regulators to promote effective disclosure, again, as opposed to what I would refer to as voluminous disclosure? Has the GAO concluded that consumers can and should understand the risk associated with their mortgage products?
First, we've made a number of recommendations. I'll ask Mr. Hillman to elaborate on those in a series of products over time about making the disclosures more understandable to consumers. There's ways to do research on this, to do some testing as to what the consumers would really understand and put in place. As I've also grown to appreciate over time, some of the disclosures are in, as you mentioned, a teeny tiny condominium or in teeny tiny print, so they're even hard to read. But there are a number of ways that we believe and have recommended that the disclosures could be improved over time. And I also, though, would not also overlook the issue of financial literacy training to our population at large over a period of time.
I see my time's winding down. I'd like to try to squeeze in at least one more question here. Did the GAO look at the enforcement mechanisms that are in place to deal with mortgage fraud? According to FinCEN, Financial Crimes Enforcement Network, mortgage fraud has increased something along the lines of 1,400% in this decade. A lot of predatory lending, frankly, a lot of predatory borrowing. I think according to FinCEN, a majority of the mortgage fraud occurred from borrowers misrepresenting their income, misrepresenting their assets, misrepresenting their occupancy. Anecdotally, I've spoken with a number of U.S. attorneys, assistant U.S. attorneys. They're focused on terrorism. Unless you're into 7- and 8-figures fraud, they don't even look at it. So has the GAO undertaken a look at what would it mean to simply enforce some of the anti-fraud regulations that are on the books today?
Mr. Dodaro, we're out of time, so I'm just going to ask you to limit yourself to just a sentence on this if you could, or Mr. Hillman.
Right. I'd be pleased to respond, and your question again is right on target. We have not done any specific work as it relates to the elements of mortgage fraud and the growing nature of that, but we have recently completed 2 pieces of work in the Bank Secrecy Act area, which looks at the extent to which depository institutions are preparing suspicious activity reports and currency transaction reports to help law enforcement agencies tackle that problem and try to determine the most efficient means for depository institutions to comply with the Bank Secrecy Act.
Thank you. Thank you, Madam Chair.
Thank you, Congressman. Mr. Silvers?
Again, let me express my thanks to the GAO for your assistance to our panel in our brief period of existence, and for your own work on the TARP program. Your report and your comments before us this morning refer at some length to unregulated both financial institutions and financial products. This follows, I think, a long series of GAO reports dating back to long-term capital management in relation to some of these same issues. Could you expand on your thinking in that area, and with particular reference to the proposition some have raised, including, I think, some witnesses that will follow you, that many of these products and firms are essentially well-known things in new legal garb and ought to be regulated based on economic content rather than legal form? So, for example, a credit default swap looks a lot like bond insurance.
I think, basically, and I'll ask Ms. Williams to elaborate on this a little bit, our work in this area dates back to a 1994 report where we raised questions about the derivatives and the development at that period of time. I think this is an area where there needs to be, and whatever changes are made to the regulatory framework, you can deal with the existing set of institutions and products now, but looking forward is really the challenge, I believe, going forward. As new products are developed, there needs to be some attention made by the regulators to make a gauge as to what the risk would be, whether it fits into an already existing regulatory scheme, make a conscious decision, and then also monitor that very carefully going forward and make proposals if they don't already have the authority. So I think the challenge really there is to really looking forward as well as dealing with what we already have.
Can I, before you ask your colleague to contribute, Are you suggesting that you would support regulatory frameworks like, for example, the 33 and 34 securities laws that give broad broad conceptual jurisdiction to regulators to follow the activity rather than approaches that sort of wall regulators in around particular legal forms?
Yeah, yes. I mean, they need some authorities on a risk-based basis. You can't, you don't want it to go too far that it stifles innovation, but there has to be a risk assessment tool built in that we think would provide a better safeguard going forward.
And just to add, we have several elements that really speak to that. That's what we're getting at when we talk about the need for comprehensive regulation as well as flexible and nimble. And that's to allow the structure to adjust as entities and products morph, to be able to follow the economic substance of the product and also look to the institution, engage its impact on the overall financial system, and not be locked into a statutory definition.
Would I be correct in following up with that, that you would look in this respect to regulation, for example, with a particular financial product or an institution that currently is outside the regulatory scheme, that you would look both at, for example, transparency, accountability, and capital requirements as required by the particular activity going on? Am I clear in what I'm asking?
I would think that would have to be part of the debate as you decide how far to go with regulating that particular entity based on its risk to the system. You would have to evaluate if that would be appropriate for all of those items that you listed.
And there's really two levels here. One is in the individual regulatory scheme that would be put in place, but also this entity that would focus on systemic risk would also have some responsibilities in this area and to coordinate with the individual regulatory entities.
Coming to the systemic risk question, one item in the debate that's not, I think, been entirely clear and focused, but seems quite important to me, is the approach to systemic risk regulation, whether essentially one tries to identify systemically significant institutions ex ante in advance and regulate them with bring special regulatory tools to bear in advance, or whether whether it is better not to do that, whether it's better to essentially determine who's systemically significant in the midst of crisis, which is, I think, essentially what we've done recently. What's your thinking about that question?
Two thoughts. One, I think in putting a new regulatory structure in place right now, there has to be a recognition of these large financial conglomerate entities that do, in fact, right now, have significance to the system at large, and there has to be an appropriate structure put in place to deal with that going forward. Recognize we're in a global environment, and we need to have those entities to be competitive, but it shouldn't be static. I think one thing that's really surprised everybody is the speed in which these things have happened, and you can't wait to be in a reactive posture. That is just not going to serve us well. We need to put a durable system in place that's going to be able to recognize what we already know, but yet be flexible enough to be proactive going forward if you're really going to mitigate things given the current globalized environment.
Thank you.
Thank you. Senator Sununu?
Mr. Dodaro, I'm going to give you an opportunity here now to give us some good news. In your work and your evaluation of the regulatory system we have and the events that led up to the current crisis, what did you find that operated effectively, that seemed to be working, or best practices within our regulatory structure that we should look to expand or reinforce?
Well, I think, basically we have a regulatory system, where the regulators are, developing mechanisms to try to coordinate with one another to deal with some of the things. So I think the dialogue among the regulators has improved, although it hasn't gotten to the point of where we would recognize that it's the most effective and efficient way to be able to handle the system going forward. I think in the current environment and dealing with the situation, the regulators have, acted, I think, to try to deal with and stem and mitigate the effects of the current system going forward with the tools that they have at their disposal to be able to do that and have acted in order to try to deal with some of the issues going forward. There are a lot of very talented people in the financial regulatory area. We have a lot of well-intended systems in place to be able to do this in areas where there's been traditional oversight. For example, in the commercial banking industry, we think some of those things have worked effectively over time, given some of the incremental changes that you mentioned. I would just ask Rick or Roars if I've missed any. I don't want to miss any good news.
I'd just like to reiterate what Gene was saying, in that given the fragmented regulatory structure that we currently have in place, one of the major benefits of that fragmented structure is that these individual regulators have deep pools of knowledge and an understanding of their individual markets that they're overseeing. So that has allowed, in this particular financial crisis, given the more effective coordination that has taken place across regulators between the Department of the Treasury and the Federal Reserve, including the Federal Deposit Insurance Corporation, in their particular areas of expertise and the authority that they provide, it has allowed for a more concerted strategy to address the case-by-case problems that have been confronting our financial markets over this past summer.
In recommendation number 5, you talk about the importance of eliminating overlap. Could you give us an example of some particular areas where you saw this overlap and perhaps some of the problems it created?
Yeah, basically, the one area where we recommended that it be dealt with is in the banking area. Right now you have 5 entities that have responsibilities at the federal level in that regard. I think there's some merit of looking at in the futures and the security areas, the SEC and the commodity futures trading corporations as well. Those would be the 2 primary areas that we would highlight for that merit consideration.
On the issue of consumer safety, Mr. Hellman used the phrase working to ensure that consumers are best protected, talked a little bit about the Twin Peaks model, where you separate this responsibility for consumer protection. But that can create problems, and maybe even significant problems, and that there are elements of consumer protection or consumer services that could and would have a direct effect on the safety and soundness of the institution. And it would be a mistake to have an agency or an organization responsible for those consumer protection initiatives or consumer initiatives without also having an obligation and a responsibility to think through exactly what the effect on this regulation would be on safety and soundness. So how do you reconcile that problem, and how can you advocate a Twin Peaks model if it separates those 2 obligations and responsibilities?
Well, the work that we have done in looking at various alternative regulatory structures suggests to us that there are definite strengths and weaknesses across a series of possible options for reforming our regulatory structure, and there really, quite frankly, is no silver bullet. Looking at the Twin Peaks model, where you have oversight by objective, looking at safety and soundness issues or looking at consumer protection issues, it does afford the opportunity to enhance the visibility from a consumer protection standpoint. But your comments are very on target when you suggest that separating consumer protection from a safety and soundness issue can cause problems. One area, for example, that could be a problem has to do with really assessing reputational risk. There's issues associated with the operations of enterprises and institutions that can cause reputational risk and also harm investors, and you really need to look at that at a holistic level. So there's strengths and weaknesses to each approach.
And I think at a minimum, there needs to be clarity of the goals and objectives that are put in place for whatever system's put in place. And part of the reason we created the 9 characteristics is that there's a tendency to want to gravitate to a quick organizational fix by either centralizing or decentralize something. Often that doesn't work. It's not as simple as that might seem, even appealing as it may be. This is one area where once you set what kind of structure you want in place, even if you don't go to a centralized approach, you need to make clear what the responsibilities would be in the framework in what you're talking about. And I think that's an area where I'd want to make sure that, you know, our message that the minimum requirements need to be really clearly spelled out as to what you expect. You know, what does Congress expect in this area?
Thank you. Mr. Neiman?
Yes, Mr. I'd like to follow up on that line of questioning because, you know, in your written testimony, you do note that unfair consumer lending practices can have safety and soundness implications, and I agree with that assertion. And you also noted that if consumer protection and safety and soundness responsibilities were housed in different agencies, that appropriate mechanisms for interagency coordination would be required. Now, do you have any specific recommendations for processes to overcome those operational challenges, or does the fact argue in favor of keeping consumer protection and prudential supervision within the same agency?
Well, a lot would depend. Honest, Rick's been focusing on our work here to comment. A lot would depend on what type of other changes are made in the system to the financial regulatory apparatus that would be put in place. So you'd have to consider that in arriving at the answer. But Rick?
There's definite trade-offs that take place depending upon which option you end up choosing. If you're looking at a bifurcation of safety and soundness and consumer protection issues, it's definitely going to put a premium on coordination and communication and collaboration between those entities that have those responsibilities. If you put it in one organization, you have the opportunity to share expertise and information across those two important issues, but then you may lose focus as to what you're really looking to achieve. So depending upon whichever structure you ultimately move to, Gene is absolutely right. We need to establish what goals need to be in place to ensure effective consumer protection and have those goals drive down the regulatory process to achieve them.
Now, in that same section, you talk about overlapping jurisdiction of regulators, and to a certain extent, in certain areas, it can be burdensome, but in other areas, it can provide appropriate checks and balances. And that, from my experience as a state regulator, I have seen that play an important role where we work very cooperatively and serve in a with our countervailing federal regulators. You also indicate that with respect to enforcement activities, that is a less burdensome area, and where I assume what you're getting at is more cops on the beat rather than less is important. Would you elaborate on this, the balance between checks and balances and overburdensome regulatory overlap?
Yeah, I think the real goal would be to capitalize and build upon those things that are working well right now and that provide those checks and balances. I think, you know, our view on overlapping regulation is more at the federal level than it would be between the federal government and at the state level. So I'd want to clarify that. I think there's distinct advantages of having the states be involved in this process going forward. We think there are opportunities at the federal level. So you need to preserve the checks and balances. It's a big system. It's complicated. It's moving fast. The states give you a decentralized sort of eyes and ears on the ground across the country, and I think you don't want to lose that ability to be able to do that going forward. So but that's most of our focus is at the federal level.
Thank you.
And particularly to your point on the checks and balances, you know, while GAO has not made any proposals suggesting how to reform the financial services sector, we have suggested, though, that we need to seriously look at some consolidation of the financial services sector. And that is not to say that we are trying to eliminate competition across regulators. That would be an inconsistent reaction to what our view is. You know, competition across regulatory agencies help to ensure innovative structures within the federal and state levels, and in some form would likely be benefited by preserving the regulatory competition that exists. The question is, though, is there too much competition now across the many organizations that exist?
Have you addressed in any way the issues around federal preemption of state laws, particularly state consumer laws?
We have acknowledged in prior work concerns associated with a federal preemption, particularly as it relates to the Office of Control of the Currency and steps that it had taken earlier this decade to limit visitorial powers associated with states' interaction with national banks. And as a result of that work, had suggested that the OCC could do a much better job of determining how they could best incorporate state banking authorities and powers within the confines of what they were referring to with their visitorial powers.
And we'd be happy to provide that for your record consideration.
Thank you.
Thank you. Thank you, Mr. Neiman. That's going to conclude the testimony for Panel 1. The press of time bumps into the magnitude of the task that we have undertaken. I want to ask if you would be willing to answer written submissions from the panel on the record that we would send to you in the next few days.
We'd be happy to assist this panel in its important task any way we can, certainly.
Thank you, Acting Controller Dodaro, and thank you, Ms. Williams. Thank you, Mr. Hillman. The panel appreciates your taking the time and coming here.
Thank you very much.
Thank you again. We now call the second panel. If you'll come forward, please. It is. And they're having trouble with their names. Something Do we have everyone? Thank you. I'm pleased to welcome our second panel of witnesses. We are joined by Sarah Bloom Raskin, Commissioner of the Maryland Office of Financial Regulation, by Joel Seligman, President of the University of Rochester, Robert J. Schiller, the Arthur M. Okun Professor of Economics at Yale University, Joseph Stiglitz, University Professor, Columbia Business School, Mark Summerlin, Managing Director and co-founder of the Lindsay Group, and Peter J. Wallison, Arthur F. Burns Fellow in Financial Policy Studies of the American Enterprise Institute. Welcome to all of you. I will dispense with more and just say, can we start? Each of you will have your full statements on the record, of course, if I can ask you to limit your oral remarks to 5 minutes. And we'll start with Ms. Raskin.
Thank you. Good morning, Madam Chair and members of the panel. My name is Sarah Bloom Raskin. And I am Maryland's Commissioner of Financial Regulation. I'm pleased to be here today to share a state perspective on regulatory restructuring. While changing our regulatory system will be complex, 4 simple concepts should guide us. In evaluating any proposed reform of our financial regulatory system, we must ask, 1, does it enhance transparency? 2, does it enhance accountability? 3, does it promote the public interest? And 4, does it address systemic risks? We often hear that the consolidation of financial regulation at the federal level is the modern response to the challenges of our financial system. I want to challenge this idea. The 6,000-plus state-chartered banks now control less than 30% of the assets in our banking system, but they make up 70% of all U.S. banks. Thus, While these institutions may be smaller than the international organizations now making headlines and winning bailouts, they are absolutely critical to the communities they serve. Since the enactment of nationwide banking, the states have developed a highly coordinated system of state-to-state and state-to-federal bank supervision. This is a model that embodies the American dynamic of both vertical and horizontal checks and balances, an essential dynamic that has been sharply missing from certain areas of federal financial regulation, with devastating consequences for all of us. Remember the ultimate Madisonian theory behind separated powers. This design would restrain ambitions, prevent capture by specific factions, and avert corruption. The very definition of tyranny, Madison thought, was the collapse of all powers into one. The problems we face today do not come from regulatory federalism, but rather from the convergence of regulatory centralization and good old-fashioned regulatory capture. Bank regulators like to say that our job is to take away the punch bowl once the party really gets going. But our federal banking regulators made themselves the ruling chaperones of the party and worked with their friends on Wall Street to spike the punch bowl. The current crisis has thus revealed shocking defects in regulatory and political will in Washington. Perhaps it is true, as the GAO asserts, that gaps in our divided regulatory structure made it more difficult to understand the gravity of the risks that were building in the system. Perhaps. But the disasters we have experienced are not failures of structure. They are failures of execution, political will, and policy. I do not want to discount the need for significant regulatory changes, and we outline these gaps in our submitted testimony. But those reforms will not address the underlying problems if we fail to understand and address why the federal system did not adequately respond. From the state perspective, it's not been clear for many years exactly who was hosting the party, who was chaperoning, and who the special guests were. The nation's largest and most influential financial institutions have themselves been major contributing factors in our regulatory system's failure to respond to this crisis. From our foxholes at the state level, we have watched the regulatory apparatus in Washington show telltale signs of classic regulatory capture, political, economic, and intellectual capture by the regulated industry. If this is right, a consolidation of regulatory authority at the federal level would only exacerbate rather than relieve our troubles. From this standpoint, many of the policies of TARP and other federal responses to contain this crisis interfere with our ability to prevent the next crisis. It would be like saying, in the wake of Hurricane Katrina and its aftermath, that the solution is to get rid of local fire departments and first responders and centralize more authority and power in FEMA. Regulatory capture becomes more rather than less likely with a consolidated regulatory structure. It was the states that attempted to check the unhealthy evolution of the mortgage market and apply needed consumer protections to the tidal wave of subprime lending. It was the states and the FDIC that were a check on the flawed assumptions of the Basel II Capital Accord. The lesson...
Your time is up. Can I ask you to conclude?
Yes, I'll finish up. The lesson of this crisis should be that these checks need to be enhanced, multiplied, and reinforced, not eliminated. If we've learned nothing else from this experience, we've learned that big organizations have big problems. And as you consider your responses to this crisis, I ask that you consider reforms that promote diversity and create new incentives for the smaller, less troubled elements of our financial system, rather than rewarding the largest and most reckless. At the state level, we're constantly pursuing methods of supervision and regulation. I appreciate your work toward this goal, and I thank you for inviting me to share my views today.
Thank you, Ms. Raskin. President Seligman.
Chair, or Professor Warren, members of the panel, I'm delighted to join you here.
Mike.
There is today an urgent need for a fundamental restructuring of federal financial regulation, primarily based on three overlapping causes. First, an ongoing economic emergency, initially rooted in our housing and credit markets, which has been succeeded by the collapse of several leading investment and commercial banks and insurance companies, dramatic deterioration of our stock market indices, and now a rapidly deepening recession. Second, serious breakdowns in the enforcement and fraud deterrence missions of federal financial regulation, notably in recent months as illustrated by matters involving Bear Stearns and the four then independent investment banks subject to the SEC's former Consolidated Supervised Entities Program, the government creation of conservatorships for Fannie Mae and Freddie Mac, the Bernie Madoff case, and more generally a significant decline in the number of prosecutions for securities fraud, at least in 2008. Third, a misalignment between federal financial regulation and financial firms and intermediaries. The structure of financial regulation that was developed during the 1930s has simply not kept pace with fundamental changes in finance. Against this backdrop, I would offer the following broad principles to guide consideration of a restructuring of federal financial regulation. First, make a fundamental distinction between emergency rescue legislation, which must be adopted under intense time pressure, and the restructuring of our financial regulatory order, which will be best done after systematic hearings and background reports. Second, the scope of any systematic review of financial regulation should be comprehensive. This not only means that obvious areas of omission today, such as credit default swaps and hedge funds, need to be part of the analysis, but also means, for example, our historic system of state insurance regulation should be re-examined, as well as current securities laws exemptions for areas including municipal securities. A re-examination also is urgently needed of the adequacy of the current regulation of credit rating agencies and the scope of investment advisor exemptions. In a world in which financial holding companies can move resources internally with breathtaking speed, a partial system of federal regulation runs an unacceptable risk of failure. The fact that the federal government provided over $100 billion to insurance giant AIG alone suggests that insurance regulation is no longer purely a state matter. Third, Congress especially should focus on the structure of financial regulation rather than addressing specific standards at too great a level of granularity. With respect to structure, I would propose consideration of a revitalized approach to federal financial regulation that at the highest level designates the Federal Reserve System as the apex or supervisory agency for all financial regulation, with the express mission to address and minimize systematic risk. This is not Twin Peaks. This is more a holding company structure where it must have comprehensive access to data, confidence in examinations to be able to address the problems of systematic risk, which are not limited to any area. Second, to preserve the expertise necessary to industry-specific regulation, I would nonetheless suggest consolidating industry-specific regulatory agencies in areas such as banking and thrift, securities and commodities, to preserve expert examination, inspection, and enforcement roles. Particular attention here should be devoted to revitalizing enforcement, including the effective use of private rights of action and self-regulatory organizations to complement the role of the federal regulatory agencies. And third, effectively allocate unregulated areas so that we eliminate today's regulatory holes. Let me suggest in closing that there is a wise caution that a member of your panel suggested before. While I'm suggesting that any new system of federal financial regulation should be comprehensive, the fragility we have seen in global financial markets in recent months inevitably will reduce for a time willingness to rely solely on self-interest of the markets to provide optimal behavior. As SEC Chair Christopher Cox memorably wrote when the Commission disbanded the Consolidated Supervisor Entity programs, quote, "Voluntary regulation does not work." The challenge in a new order will be also to avoid the tendency to over-regulate. Independent regulatory agencies such as the SEC often have shown talent in customizing congressional enactments often adopted in times of crisis to achieve the best balance between investors and industries. That talent today also is urgently needed.
Thank you, President Seligman. Dr. Schiller?
Okay. I have written 2 books about what we should do in this crisis. One of them, called Subprime Solution, came out in September, and one of them with George Akerlof called Animal Spirits will come out next month. I cannot summarize all of the things that I said in those books, but basic point, I think that we need to democratize finance, and we need to develop new financial institutions. This is a time when we have to have the spirit of the New Deal about us, that we are going to create something that will bring us into the 21st century. In my brief remark, the point is that we have to go for specific ideas, not just rearranging the regulators. It's not about saying no, it's about coming up with something new. So I want to give some examples of new ideas. One of them is from the Squam Lake Working Group, which is advising academics, a nonpartisan group, and it goes back to an idea of Mark Flannery. And the idea is that firms, or banks particularly, should be encouraged to issue a new kind of debt, which we call regulatory convertible debt. Regulators get involved in telling companies they can issue this debt, and it will count as capital. It will convert to equity if a trigger is reached, which could be merely that the regulator decides that we're in a financial crisis, or it could be based on some objective trigger. But the point is that the capital that banks have would be automatically increased by converting debt to equity at a time of crisis. This is very different than having TARP come in with public money and contribute it to capital at a time of crisis. And it would prevent the kind of, this is really central, because it would prevent the kind of downward spiral that created the crisis we're in. This is financial innovation that works at the fundamental problem of systemic vulnerability. Now, some other ideas. One is, from my book, the government ought to be subsidizing personal financial advice. This is expensive, but it is important. The crisis was substantially due to errors that people made, and I would track that back to the fact that they were not getting advice. The cheap thing to do is financial education. That can be really cheap. All we have to do is think of a curriculum and put it on the web. But that doesn't work for many people. They cannot read the complicated brochures or whatever. They need someone to help them. Third idea, it's really yours, Elizabeth, the idea of a Financial Products Safety Commission. I'll let you explain that. But I think, once again, it is about democratizing finance, about having someone representing the individual. Fourth point, I think that the real fundamental problem which underlies this crisis is a failure of risk management. And so instead of saying no to new financial derivatives, we have to make them work better for everyone. And I think that means expanding the scope of our financial markets. Notably, real estate is a risk which is underlying this crisis and is not hedgeable, it's not manageable. And the kinds of securities that we've developed to manage such risks entail unfortunate counterparty risk and systemic risks. So we have to think about how to make it possible for a broader array of risks to be managed. And finally, excuse me, finally, I talk about in my Subprime Solution book a new mortgage institution that we could create, which would be helpful in managing the risks of families. I call it a continuous workout mortgage. This would be a mortgage that would automatically adjust the payment the way a workout does in response to objective factors, continuously and automatically. That is, for example, if we fall into a recession or we see a big drop in home prices, there would be a formula written into the mortgage contract that would automatically adjust down the payment and the principal. If we had had such a thing in place today, it would have prevented a lot of economic suffering. Instead of having families go through months or years of difficulty in paying their mortgage and then running out and going in begging for help, we would have had them helped automatically. And so these are the kinds of ideas that I think we have to think about. It's ideas that are innovations and that represent creative new solutions to the problems that we've seen.
Thank you, Dr. Schiller. 2 books, 5 minutes. Nice job. Dr. Stiglitz.
Well, thank you for holding these hearings. I feel quite strongly that part of the reason that our financial system has performed so poorly is inadequate regulation and regulatory structures. There is a lack of confidence in our financial system, which is well earned, but how can there be restoration of confidence when all we have done is to pour more money into the banks? We have changed neither the regulatory structures, the incentive systems, nor even those who are running these institutions. While everyone talks of the need for better regulation, the devil is in the details. Some will push for cosmetic reforms, not the real reforms that we need. Those who engage in deceptive financial practices will push for deceptive regulatory reform. It is hard to have a well-functioning modern economy without a good financial system. However, financial markets, as has already been said, are not an end in themselves, but a means. They are supposed to mobilize savings, allocate capital, manage risk, transferring it from those less able to bear it to those more able. By contrast, our financial markets have encouraged excessive consumption, misallocated capital. Instead of managing risk, they created it. These problems have occurred repeatedly and are pervasive. This is only the latest and biggest of our bailouts, each of which reflects a failure of our financial system to fulfill its basic functions, including ascertaining creditworthiness. The problems are systemic and systematic. These failures are in turn related to 3 more fundamental problems. Markets only work well when there are well-designed incentives, a high level of transparency, and effective competition. America's financial markets fail on all accounts. Markets only work well when private rewards are aligned with social returns. Incentives matter, but when incentives are distorted, we get distorted behavior. Our banks had incentives designed to encourage excessive risk-taking and short-sighted behavior. Lack of transparency is pervasive in financial markets and is in part the result of flawed incentive structures. Indeed, those in the financial markets have resisted improvements such as more transparent disclosure of the cost of stock options. This provided incentives for bad accounting. Failure to enforce strong competition laws results in institutions that are so large that they are too big to fail, almost too big to be bailed out. That provides an incentive to engage in excessively risky practices. When financial markets fail, as they have done, the costs are enormous. There are, as economists put it, severe externalities. The losses include not only the budgetary costs in the hundreds of billions of dollars, but also costs to our entire economy, totaling in the trillions before we have fully recovered. The damage to our standing in the world is inestimable. Good regulation can increase confidence of investors in markets and serve to attract capital to financial markets and can encourage real innovation. Much of our financial markets' creativity was directed to circumventing regulations, taxes, and accounting standards. Accounting was so creative that no one, not even the banks, knew their financial position. Meanwhile, the financial system didn't make the innovations which would have addressed the real risks people face, such as how to stay in their homes when interest rates change or economic conditions change. And Professor Schiller has shown how it's easy to come up with innovations of this kind, and not only that they didn't do this, they resisted these kinds of innovations. In short, regulations can help markets work better. We need regulations to ensure the safety and soundness of individual financial institutions and the financial system as a whole, protect consumers, maintain competition, ensure access to finance for all, and maintain overall economic stability. They need to focus both on practices and products. It has been commonplace to emphasize the need for more transparency, which is why any retreat from mark to market would be a mistake. But we should realize that lack of transparency is a symptom of deeper problems, and even if transparency initiatives were fully effective, much more needs to be done. For instance, even if there were full transparency, some of the products the financial markets created were so complex that not even their creators fully understood their risk properties. We have to ensure that incentive structures do not encourage excessively risky short-sighted behavior. We need to reduce the scope of conflicts of interest, which are rife within the financial system. Securitization, for all the virtues and diversification, has introduced new asymmetries of information. Forcing originators of mortgages to bear some of the risk would mitigate some of the resulting moral hazard. Derivatives and similar financial products should neither be purchased nor produced by highly regulated financial entities unless they have been approved for specific uses by a Financial Product Safety Commission, unless their use conforms to the guidelines established. They should be instruments for laying off risks, not instruments for gambling. Regulators should encourage the move to standardized products. Greater reliance on standardized products rather than tailor-made products may increase both the transparency and efficiency of the economy.
Dr. Stiglitz, can I ask you to wrap up your overview?
Okay. There are a large number of other reforms that I talk about in my written comments. Let me just conclude by saying TARP has failed partly because of the failure to do anything about regulation. We need to impose conditionality on the use of the funds, or if we are to have any confidence that the funds, the next tranche of funds, have better outcomes than the last tranche of funds. We need, as Professor Schiller has pointed out, to encourage more innovation. One way of thinking about this is if we had taken $700 billion and created a new institution, and it had used a normal leverage of 10 to 1, we could have created a flow of credit of $7 trillion if we started afresh, rather than bailing out the failed institutions of the past. Now, no one has proposed that, but the point I want to make is we are putting an awful lot of money in the system. It's not working. And if we are going to avoid another bailout of the kind that we've had repeatedly, and remember, it's not just the S&L bailout, it's the Mexican bailout, the Indonesian, the Korean, our bailouts of the financial markets. They're not bailouts of the countries. They represent failed lending practices of our financial institutions. Unless we impose better, smarter regulation, we will have another one of these encounters in a short period of time.
Thank you, Dr. Stiglitz. Mr. Summerlin?
Madam Chair, members of the panel, thank you very much. My name is Mark Summerlin. I'm Managing Director of the Lindsay Group, an economic consulting firm. Previously, I was Deputy Director of the National Economic Council in 2001 and 2002. We are in the midst of an economic contraction that is currently mirroring the worst months of the 1974 recession, one of the sharpest post-World War II periods of decline for our country. Despite all of the actions to date, it has been impossible to completely stop the deterioration because the economy is deleveraging and in fact needs to shed leverage after a decade of excessive borrowing. Credit market liabilities in the United States soared from 250% of GDP in 1997 to 350% of GDP in 2007, reaching over $50 trillion. Over this time, the economy has suffered from the rapid deflation of two asset bubbles. While both consumers and the financial sector still need to reduce their debt burden, a central goal of the emergency policies has been to slow the pace of deleveraging to minimize the negative feedback loops that occur during a sharp economic downturn. The goals of longer-term reform strategies are quite different and should focus on preventing excessive leverage from happening in the next cycle. In thinking about reform of the regulatory structure, I believe it is imperative to consider the proper role of monetary policy as well. In my written testimony, I have described in detail where I believe policy across government failed in the past. Now I'd like to focus on three broad recommendations, all centered on preventing excessive leverage from building up again. The first recommendation is for the Federal Reserve to take a more active role in preventing asset and credit bubbles from forming in the first place, as I believe is mandated under the Federal Reserve Act. During the 1990s, there emerged a widespread belief that central bankers had learned from their inflationary mistakes of the past and that another end-of-history moment had arrived where everyone could relax or at least prosper. There is a new consensus view that monetary policy should effectively target a low level of goods and service inflation while ignoring asset prices, except to the extent that they signal a change in future inflation. Not only would asset bubbles and credit that fuel them not be resisted, but policymakers believe they should aggressively lower interest rates after an asset bubble pop to mitigate the damage. This created an asymmetric bias that traders referred to as the Greenspan put. This bias towards easy monetary policy also created a bias towards overvalued assets that would eventually collapse under their own weight. In fact, financial bubbles are dependent on an accommodative monetary policy in the first place. The Federal Reserve needs to take a more active role in promoting financial stability. While the Fed has from creation adopted the lender of last resort role, it has not always embraced a policy of mitigating boom-bust cycles and asset prices. But under the Federal Reserve Act, the central bank is obligated to, quote, maintain long-run growth of monetary and credit aggregates commensurate with the economy's long-run potential to increase production. This gives the Federal Reserve a responsibility to prevent asset bubbles since they are fueled by excess credit. The second recommendation is to shift housing policy from subsidizing leverage to promoting equity, as the central bank was not the only part of government that was complicit in the housing and credit bubble. Government housing policy has been designed to directly subsidize leverage. The most expensive housing policy the U.S. has is the tax deduction on mortgage interest payments, which lowers borrowing costs. This is why realtors commonly refer to your interest payments as your, quote, tax deduction. Both the Clinton and the Bush administration has pushed various programs that supported easier access to housing credit and lower down payments, which by definition creates leverage. At the same time, the private sector seemed determined to outdo the government's lead at the peak of the bubble. In 2005, a remarkable 43% of all first-time homeowners put zero down or took out a mortgage in excess of the value of the home. It's worth emphasizing here that buying a house without a down payment is not home ownership. It is renting with risk. To the extent possible, government subsidies to leverage should be replaced with broader programs that help build equity, such as down payment matches for new homeowners. My last recommendation is to support a binding limit on the amount of leverage that is permitted by banks and other financial institutions that act as banks. A large part of the financial system, most notably commercial banks under the regulation of the FDIC, already has a limit on their leverage. These banks are subject to a simple leverage ratio that caps their assets relative to their capital. Notably, investment banks were not subject to this limit. For covered banks, if the leverage ratio drops below 4%, the FDIC must start supervisory intervention. And if the leverage ratio drops below 2%, the bank is considered critically undercapitalized and is shut down. This system means that any bank that is leveraged more than 25 to 1 will be under intense regulatory scrutiny. Banks hate these simple calculations because they cannot easily be skirted, which is the very point. It is worth remembering that banks are inherently risky entities. John Maynard Keynes once quipped that a prudent banker is one that fails at the same time that all other bankers fail. But this inherent riskiness is why banks need more limits than other parts of the economy. A binding leverage ratio is simple, transparent, and blunt form of regulation, all attributes that could make it a useful form to bank regulators around the world.
Mr. Summerlin, can I just ask you to finish your overtime?
Absolutely. The last point I would make adding to that is at the same time all efforts have to be made to move off-balance sheet activity back on balance sheet, as will soon be required under FAS 140. And I'd just like to make one more note that both the housing and credit bubble was exacerbated by the psychology of a bull market, which is important to always keep in perspective, which adversely affected the judgment of home buyers, market participants, and regulators. Thank you very much.
Thank you, Mr. Summerlin. And Mr. Wallison.
Thank you. Is this on? I guess it is. Very pleased to have this opportunity to testify today, and I assume my prepared remarks will be
of course.
Put in the record. My testimony actually will focus mostly on safety and soundness regulation, but I'd be happy to answer questions about any other kind of regulation. With the limited and disastrous exception of the major investment banks, the federal government has never regulated the safety and soundness of financial institutions for which it does not assume some financial responsibility. There are sound and strong reasons for this. First, regulation itself introduces moral hazard. Participants in the financial markets may believe that government supervision reduces the likelihood of missteps or failure, and this impairs market discipline. Second, regulation also impairs competition, suppresses innovation, increases consumer costs, and enhances the likelihood that taxpayers will be called upon to bail out regulated companies. Third, there is no policy reason why the government should take responsibility for preventing the failure of financial institutions that it does not back. In general, business failures are good for the economy and the financial system. They remove bad managements and bad business models and make room for good managements and business models. If regulation is in fact effective in preventing bad managements from failing, which is doubtful in any case, it would be preserving bad managements and business models. Fourth, regulation is apparently not effective in preventing business failures. We can see that from the current financial crisis, in which heavily regulated commercial banks are in the most trouble. In fact, given the disastrous conditions of the banks, it is difficult to understand why anyone would be calling for the regulation of other participants in the financial system. If regulation does not prevent failures, why impose its costs on consumers and taxpayers? Nevertheless, only a recently landed Martian would not realize that there is a major move afoot in Congress to broaden the scope of regulation to include other participants in the financial markets. The ostensible reasons for this are usually two. Regulation, it is said, will improve transparency and reduce systemic risk. As outlined in my prepared testimony, neither reason is persuasive. Transparency itself is a reasonable goal, but it is not worth the tangible and intangible costs of regulation when institutions are dealing solely with sophisticated counterparties. These counterparties can fend for themselves and know what questions to ask. As to reducing systemic risk, there are no examples of the failure of a non-regulated institution causing systemic risk, including LTCM, Lehman, and AIG, or any of the hedge funds that have closed their doors this year. Lehman's failure did not cause systemic risk. No institution failed or was threatened with failure because Lehman collapsed. The market freeze up after Lehman was not caused by losses coming from Lehman's failure, but by a sudden recognition on the part of banks and others around the world that their counterparties might be very weak and unstable and that the U.S. government could not be expected to rescue them. Accordingly, the opponents of new regulation, based on the danger of systemic risk, should explain why it is suddenly necessary. Finally, it would be a very bad idea to empower some agency, the Federal Reserve or anyone else, to identify systemically significant institutions and regulate them as such. This would have very adverse effects on competition. By creating the impression that some institutions are too big to fail, which is what it means to be designated as systemically significant, such a policy would create an unlimited number of Fannies and Freddies that would have huge competitive advantages over others in the same industry. As we see from bank regulation, traditional financial supervision does not work anyway and will not prevent financial failure. To be sure, there are some areas where regulation is necessary, especially when financial institutions like commercial banks are backed by the federal government. The GSEs are another example. Accordingly, in my prepared testimony, I recommend a few major changes in traditional regulation for these cases of necessary regulation. The purpose of these reforms are to enhance market discipline and make regulation counter-cyclical rather than pro-cyclical as it is today. To assist creditors and counterparties, I suggest that regulators should work with analysts and the regulated industry to create metrics or indicators of risk-taking. These would be published regularly and help potential creditors understand the risks that regulated institutions are assuming. One more paragraph.
One more paragraph.
This would make market discipline much more effective. I also recommend various steps that will make regulation counter-cyclical, including changes to fair value accounting, requirements for regulators to consult market sources for risk assessments, requirements for capital increases when asset values are rising, and the enhancement of the role of short sellers and hedge funds. Thank you very much.
Thank you, Mr. Wallison. In fact, Mr. Wallison, I'll just come back to you so you'll get a chance to talk some more now that we'll start our questions. And then as I was struck by your comment when you said regulation doesn't prevent failure, see the recent bank failures.
Yes.
But I also listened to Ms. Raskin. And Ms. Raskin, if I made my notes right, said, in effect, the federal regulators were captured. And they really did a pretty lousy job. And that the state regulators were watching. The state regulators saw it. They waved as many flags as they could. And that failure seems to accompany those who are governed by regulators who are not independent. Or to say it another way, non-regulation regulation seems to lead to failure. Can you respond to Ms. Raskin's point?
Sure, I think I can. I have no faith, of course, as I suggested in my oral testimony, in regulators per se. I don't think they're any smarter than the people that they are regulating, and in fact, they are always relatively behind the curve. And what happens is that we assume that regulators are actually overseeing risk-taking, and they are not. The only group that actually is interested in preventing risk-taking are creditors. Creditors are not benefited by risk-taking, and as a result, we ought to do everything we can to assure that creditors get the information about the risks that the institutions are taking so that they can make appropriate choices in lending money or withholding money from financial institutions, especially regulated
So I just want to make sure I'm understanding the point. Regulators are not smart enough to regulate, or they simply won't regulate?
Oh, I think they would love to regulate. In fact, for the larger institutions here in the United States, the larger banks, there are regulators there 100% of the time. They have offices in Citibank.
I think maybe that was Ms. Raskin's point.
Yes, of course, but I'm saying that no regulation is going to be satisfactory if we are relying simply on government people going in and sitting there and looking at what the institutions are doing. The ones who are really effective at regulation are the ones who have the incentive to do so, I believe, and those are the creditors, the people who are asked to lend them money or make deposits in those institutions or be counterparties in transactions. They need the information that they are not getting from the institutions to decide whether risks are being taken by those groups.
Ms. Raskin, maybe I could give you a chance to respond as a regulator.
Yes, well,
Hey, is your mic on? Mic on?
Thank you. I do believe that regulation works. I think that there are systems in place currently that primarily permit a great deal of coordination between state regulators and federal regulators. We have seen through recent history that regulators have been very nimble at the state level, have been very precise in dealing with the problems that have arisen, particularly the number of foreclosures that we've been dealing with on a massive level at the state level. So I do believe that regulation works. I urge, though, the panel to consider when they design a new system for organizing the regulatory boxes, that checks and balances be considered, that accountability be built in, and that mechanisms be adopted that permit coordination among the different regulators.
President Seligman, I had the sense you'd like to respond to this.
Effective regulation can increase confidence in our market.
Is your mic on, please?
I think it's on. Effective regulation can increase confidence in our markets. We've seen, for example, during the time of the SEC, the percentage of investors in this country grow from 1.5% to approximately 50%. The value of equity and debt in this country grow from $90 billion to close to $12.6 trillion. At the same time, what you referred to as non-regulation, regulation can undermine this confidence. And the classic recent illustration that has so far been reported upon is Bear Stearns, where you had too few individuals involved in administering the SEC's consolidated supervisory entity system. When problems were flagged that did not go up the chain of command, you had the wrong rules. And I commend to your attention the report of the SEC's Office of Inspector General on Bear Stearns, which documents that you have to have people who believe in regulation to administer it if you're going to deter and prevent financial misconduct.
Thank you very much. I'm nearly out of time, so I'm going to go to Congressman Hensarling.
Thank you, Madam Chair. Again, thank the panel. Mr. Wallison and Mr. Summerlin, I think you both wrote about Fannie and Freddie in your testimony. I'm not sure I heard it or saw it in the other testimony. Mr. Wallison, in your testimony, you speak about Fannie and Freddie were largely responsible for the vast inflation of the housing bubble. And Mr. Summerlin, I believe you write in your testimony that the GSEs, Fannie and Freddie, encouraged loans to people who could not afford them and essentially helped destabilize our housing market in direct contrast with their mission. I would like to give you two gentlemen, starting with you, Mr. Wallace, an opportunity to elaborate on your thoughts on precisely the role of Fannie and Freddie in our economic turmoil, and also speak, if you would, specifically to their affordable housing mission. Mr. Wallace.
Fannie and Freddie represent an effort on the part of Congress to achieve a national housing goal without doing anything in the way of appropriating funds. Instead, what they did was used two private companies that they chartered to make loans that they might not otherwise have made, but for certain housing goals that they were required to meet. As a result, Fannie and Freddie contributed about 40% of all the subprime and Alt-A loans that we are currently struggling with in our economy by making loans that, or buying loans from originators that would not otherwise have been marketable. That distorted our financial system and has ultimately been the cause of the tremendous losses that we are going to suffer in housing.
Mr.
That's
Summerlin?
my view.
Mr. Summerlin?
During the 1990s, both of the GSEs continually lowered their down payment requirements of what type of loans they would buy. Now, when the loan was below a 20% down payment, it still had to have some form of mortgage insurance, but loans were being securitized through Fannie and Freddie that did have lower and lower down payments. This is, as you know from my testimony, something that I believe is a problem when you have excess leverage to homeowners. During the peak of the housing boom, they were operating just as were private insurers in buying and thereby aiding mortgages that should never have been given. I think the GSEs, given their link to government, does tend, when they do something, to put more of a stamp of approval on it than when other people do, and therefore they had a special role to be even more diligent. And the GSEs from the beginning, were undercapitalized and had an incentive problem where they could essentially privatize profits and socialize losses, and that's a framework for taking on
Is it your
risk.
opinion that but for their government-sanctioned duopoly status that they would not have been able to do what they did?
They certainly would not have been able to do what they did with the scale they did. I mean, they existed on that scale because of their link to the federal government.
Mr. Summerlin, also in your testimony, you speak extensively, I believe, on the Federal Reserve policies, particularly in dealing with our last financial crisis after the dot-com bubble in 9/11. And I think on page 8 of your testimony, I had not realized this, that for 3 straight years, the Fed fund rate was essentially negative, as you put it, the equivalent of free money. I think there is a body of work that would suggest that the seeds for this financial crisis were frankly sown in trying to deal with the aftermath of the last financial crisis. Would you speak a little bit more extensively about your view of the role of the Federal Reserve's easy money policy in enabling the crisis that we find ourselves in?
I think that once you get yourself into a boom-bust cycle, you start doing emergency policies and other things to mitigate the current problems, and you don't always know where you're going to end up. Once we had the enormous tech bubble where the PE ratio of the S&P, for instance, got up to 45, about 3 times its historic average. And then in 2001, starting in March of 2000, we had about $5 trillion in asset losses, and the government starts to react to that. And deflating asset bubbles can be very vicious economic events. And part of the reaction to that was the Federal Reserve from 2002, 2003, 2004. Real interest rates, meaning adjusted for inflation, were effectively zero, which is like free money. Part of the other issue was the Federal Reserve, by being completely transparent with that it was going to take a very gradual path, that lowered forward bond volatility, FX volatility, and it had other sort of things that encouraged financial entities to take on more risk. And in some cases, some financial entities like pension funds, insurers, they need a 7%, 8% nominal return. And when you're operating in a very low nominal return world, they start to leverage up to try to hit the target they need to meet their internal targets.
Thank you, Mr. Summerlin. Thank you. We're over time. Congressman, thank you. Mr. Silvers?
Thank you, Madam Chair. President Seligman, I understand you have some time constraints here. I would appreciate it if you would, in writing, advise us as to specific steps to strengthen the Securities and Exchange Commission in light of your testimony. Specifically, though, my question to you is, there's been some talk of a unified consumer protection financial services entity, regulatory body. Do you view the types of substantive consumer protection that we see in insurance, mortgages, credit cards, as being easily mergeable with the sort of disclosure-based investor protection that the SEC does?
I think it's a tough analysis that has to be done. I do think, for example, a potential merger of the SEC and CFTC makes good sense for a number of reasons. I do think there needs to be very thoughtful analysis as to whether or not certain aspects of insurance should be subject to federal regulation. I do think, however, that when you try to create one consumer and investor agency across the board, you risk dissipating the expertise necessary to effective regulation. And what I'm very much concerned about when I've looked at the experience, whether it's of the SEC or other agencies, when their mandate becomes too broad, they tend not to be able to focus on everything equally well. There is a real value to expertise. The countervailing challenge, and it's been well illustrated in the recent past, is regulatory arbitrage. And for example, when you have 5 depository institution regulators, the ability of those regulators to pick and choose which format they'll be subject to does create a kind of tendency towards a race to the bottom. So it's going to take very, very systematic analysis. It shouldn't be done quickly. You need to have sufficient hearings. You need to have sufficient reports so you can reach the appropriate outcomes.
Thank you. Ms. Bloom-Raskin, you are the only member of our panel who is actually involved in the housing crisis and the foreclosure crisis in any direct way right now in your capacity. Can you shed light on the relative responsibility of in your view, based on what you've seen, of the GSEs and GSE-financed mortgages on the one hand, and of the non-GSE, entirely private sector firms on the other that were so much encouraged in the last 8 years?
I'd be happy to, and that's it's an excellent question. What I can speak to certainly is the work that we have been doing in Maryland regarding the foreclosure crisis, and we identified quite early that mortgage servicers were in fact a linchpin to working through a lot of the problems of loan modification and the need for sustainable mortgage modification. And to that extent, what we have done, and I think states are very well positioned to do, is to work individually, and it's hard work, it's a lot of heavy lifting, but to work individually with mortgage servicers, which we have done. We have hammered out agreements one by one with them in which we require certain operational fixes be made within the relationship between the borrower and the servicer, and we have worked very hard in that regard. We have also put in place a monthly reporting system by which we collect data on a monthly basis from the mortgage servicers that are doing business within our state. And in this way, we have been able to track modification efforts, and we have been able to measure the sustainability of those modifications. This, to me, these are 2 examples of how we have been able to work on a local level without really the involvement of the GSEs and Fannie and Freddie, but with the servicers over whom we do have some regulatory authority.
Thank you. Professor Stiglitz, in your written testimony, you raised the question of whether the Federal Reserve is currently structured as an appropriate umbrella regulator. I think, Mr. Summerlin, you also have some concerns about the Fed in your testimony you gave this morning. In order, Professor Stiglitz, could you comment on what changes might be necessary to the Fed for it to play the role some envision for it?
Well, first, let me say I share the view of several people on the panel that the Fed was too easily captured in the spirit of the bubble that was going on and the metaphor that was given of a punch bowl that was being spiked is, I think, absolutely correct. That's why I think it's important to make sure that the Fed becomes more representative and be much more explicit about its mandate. In the United States and around the world, there has been a focus on focusing just on inflation and commodity inflation, explicit discussion, not to worry about asset. And I think Mr. Sublin was exactly right that it needs to understand that financial stability, financial market instability is far more of a risk for long-term economic growth than an increased inflation from 2% to 2.5%.
Wrap up just because we're over time.
Okay, so the single most important thing is to make sure, like they do in Sweden, for instance, that there are representatives on the Federal Reserve Board of labor, of other people whose views may not be quite consistent with those in the investment community.
Thank you. Senator Sununu?
Thank you, Madam Chair. Listening to the testimony and some of the answers to questions, I want to begin with an observation, and that is that Mr. Wollaston's point, as I understand it, that even in areas where he would agree that regulation should be imposed because of a government guarantee, the regulators can still cause significant problems, is not at odds with the points made by Mr. Siegelman and Mrs. Raskin. In fact, I think the points that you made reinforce this point. There may be other areas where there's disagreement, but the example of the SEC Consolidated Capital Rule and the example of regulatory capture, and let's name names, OTS, these are two of the oldest and, one might argue, most experienced federal regulators that took specific action or failed to take specific action that made this crisis much worse. And I think we need to be cognizant of that and actually use that as a basis for the recommendations that we make. But, you know, I think that speaks directly to what Mr. Wollaston's concern is about the way in which existing regulatory structure can make the problem worse. Now, they could also help deal with problems, and I believe that they should. I'd like to go to Mr. Siegelman, though, not to talk about the CFTC-SEC consolidation, which I'll come back to, but you mentioned something else, federal voice for insurance regulation, and the concept of a federal charter, an optional federal charter, for example, for insurance, which is an issue that I know the Treasury Blueprint also discussed. How do you think that a federal voice for insurance regulation might work? Do you think it's necessary, given the national scope and the global scope of some of these insurance companies that we see today? AIG is obviously high profile, but there are many others. But equally important to the other panelists, those in closest proximity to you, can we still maintain a meaningful voice for state regulation in an environment where we have an optional federal charter or a federal insurance charter?
I think there are two separate reasons that you should look hard at a new federal role with respect to insurance. The absolutely imperative one now is systematic risk. That is, there are aspects of at least certain insurance corporations which required ultimate federal rescue packages, which because of counterparties were viewed as of similar consequence to commercial banks and investment banks. There is a separate, though, point, and that is the insurance regulation is anachronistic. It is the only major financial sector which is essentially purely at the state level. This creates, among other things, potential competitive disadvantages in a global economy. It creates the kind of problems that the Securities Acts in the 1930s or certain of the banking legislation has addressed through preemptive mechanisms and federalist mechanisms. It seems to me what we ultimately would be most wisely moving towards was federal insurance regulation above certain thresholds perhaps on an optional basis, but more wisely I would suggest on a mandatory basis through a chartering mechanism, and state insurance regulation on a residual basis the way you have it in securities.
Mandatory based on the aggregate assets of the insurance company, or mandatory based on the size of the policy?
I think that is the kind of question we need to systematically review, and I don't want to shoot from the hip on it. But I will suggest to you that I know there are a number of leaders of major insurance companies right now who would suggest to you that it is easier to deal potentially with one federal regulator than 55 state and similar regulators that they now have to address, and that to have one set of standards would potentially give them competitive advantages in a global economy.
But do you still see a role for meaningful participation by the states to provide a check and balance?
Absolutely. State securities regulation is absolutely vital for a number of cases. It enhances the enforcement wing. It deals with local problems. It is a laboratory by which new ideas can originate. But at the same time, for firms either in interstate commerce or above certain thresholds, the notion that we would continue to rely on state securities regulation today, people would think would be dysfunctional.
On the recommendation that the that the SEC and CFTC be combined, what do you, and I know this is an area where you've done a great deal of work, it's in your testimony, but what would you identify as the most specific obstacles to combination, and how do you recommend we overcome those obstacles?
And since we're out of time, can I ask for just a condensed answer, since I know this is in your testimony?
Oh, very simply, in a sentence, that the oversight committees in Congress for securities and commodities regulation are separate.
It's a turf war.
It is a turf war. It is not principled. It is not wise.
I don't know if that makes the problem of consolidation easier or more difficult.
Unfortunately, you do know.
Thank you. Thank you, Senator. Mr. Neiman?
I'd like to stay with President Seligman. I'd like to continue with President Seligman and follow up on your ideas for the role of the Federal Reserve as an apex agency, a systemic regulator. And if you could expand upon that as to why the Federal Reserve is the appropriate entity, how would it operate differently than we are seeing the Fed operate in our current environment?
It has been the emergency entity since at least the 1987 market crash in time after time. What it doesn't have is the right information flows, confidence in the underlying examinations so that it can anticipate problems and try to obviate risk. You have three choices ultimately: the President's Working Group, the Department of the Treasury, or the Fed. The Fed has been the one that operationally seems most competent to address this. What you want is not a Twin Peaks model, which suggests that at a similar level, you both have safety and solvency and investor and consumer protection. What you want is a very different type of approach, where you have one agency that unequivocally receives all relevant information and can address systematic risk and respond to it the way the Fed implicitly has been doing for some time now, but properly armed so that they've got confidence in information flows. And second, then you want to preserve industry expertise in a series of agencies. While it's a very crude and imperfect analogy, what we did with intelligence services after 9/11, where you have a national intelligence director but separate intelligence agencies, is a better model than the Twin Peaks.
Thank you. Mr. Raskin, it's a pleasure that you were able to join us and have a fellow regulator here, and in fact, it's probably a unique experience where a panel is made up the sole regulator is a state regulator, so welcome. You know, some have suggested that the dual banking system might make it more difficult to prevent or manage crises, and to Mr. Seligman's point, the response to 9/11, we moved to a more coordinated approach by creating a consolidated agency. Is that comparison apt, and what are your thoughts on the risks associated with moving toward a consolidated approach, the opportunity, if you had a single regulator, of missing red flags and eliminating checks and balances?
Well, I think it's a very apt analogy, and I think that the dual banking system has actually been the savior here in mitigating even greater harm that could be coming from the financial crisis that we are now all living through. So I believe that the checks and balances that are in place by virtue of that system are a good example and a good model for study as we move forward in deciding what a new regulatory system might look like. So I do think that the state examiners, the state supervisory role has been an important check. I think that state chartered institutions, by virtue generally of their size, have been able to be a good shock absorber to a lot of the systemic risk consequences we've been experiencing.
Thank you. Dr. Schiller, was very interested in your concept of the continuing workout loan, and would probably want to follow up with you after. But in the minute we have left, have you done any analysis or research around the possible unintended consequences of that in terms of impact on the market, the ability of lenders to hedge the risk? Could it result in higher interest rate loans, shorter term loans, and what would be the impact and expected reaction to the marketplace?
Well, my proposal is a market-based solution, and it involves the government only as a regulator that would make this possible. And you're asking questions that are difficult. How would market prices be impacted by an institution like this? In terms of mortgage rates, it's possible that a continuous workout mortgage would have a higher interest rate because you're getting some kind of insurance. But it shouldn't be considered a bad thing. If people have to pay a higher interest rate, they're getting a kind of risk protection. But on the other hand, we don't know how much higher, because it affects the whole economy and the whole systemic risks of the economy. So having something that protects mortgage borrowers built into the initial mortgage improves the resilience of the whole economy. And so in the long run, it might produce even lower mortgage rates.
Have we seen any other jurisdictions or countries that have, or financial institutions that have adopted it?
This has not been adopted in any country, as far as I know. But we're coming into a new century, and things have to change. And I think it's entirely plausible that as our financial markets develop, we will build in more protections for people. And this is the trend we've seen in the past, and I expect it to continue in the future.
Thank you.
Thank you. Thank you, Mr. Neiman. We're going to do a second round of questions, if you'll bear with us. And I wanted to start, if we could, with Dr. Stiglitz. I was captured by your remark, and I know there's a reference to it as well in your testimony, but that TARP has failed, and it has failed in part because of the failure to put any conditions on how the money has been distributed. And you talk about the counterfactual. If we had taken $700 billion and simply infused it in a new institution, how the world would look a little different right now. If you make the point about imposing conditions on extending TARP funds, can you just elaborate on that, Dr. Stiglitz? What would be your top 3 recommendations?
Yeah, I listed at the end of my testimony a number of recommendations. Obviously, there's broad consensus that the notion of our pouring money into these banks and having the money pour out in the form of dividends, in the form of bonuses, the form of acquisition of other healthy banks, does not lead to more lending. And so that would be an obvious condition. A second set of conditions are that there are a large number of practices that we've identified, everybody's identified as having contributed to the problem. Bad incentive structures, bad lending practices, exploitive anti-competitive practices in credit markets, predatory lending. We are now, in effect, partial owner of the banking system of these large banks, and yet we're like a slumlord. We're condoning, by providing money, and allowing the banks to continue some of these very bad consumer and investor practices. A third thing I would do picks up on what the Commissioner said. We have some banks that are in better shape than others. These are the banks that actually were spending more of their time actually lending. lending to small and medium-sized enterprises, community banks, many of whom are regulated by the states. They should have been the ones getting a disproportionate share of the money, not the banks that have proven their incompetency and gambling propensities. Moreover, they prided themselves of having moved out of the storage business and the lending business into the moving business. We've been subsidizing the moving industry. We should have been focusing on lending and asking, what is it? What parts of this sector are will get credit restored? And finally, obviously, doing something about the foreclosures.
That's very valuable. Thank you. I want to ask, and I'll spread this across people if you have different thoughts, to talk about the massive failure in the credit rating agencies that gave us the AAA ratings to instruments with enormously high risk. These private credit rating agencies that the government simply embraced and gave legal consequences to that. Can you speak to structurally how we might alter that, how we might think about a different way to do this? Did I see you shake your head no, President Seligman?
No, I didn't mean to shake my head no, but what I will suggest, you have a Hobson's choice at the moment. You either are going to have credit ratings paid for by users or providers. We have a system where credit ratings at the moment are paid for by providers. It creates a conflict of interest. It does create a situation where the oversight, until very recently, has not been as systematic as it should be. You now have the SEC engaged in an almost frantic catch-up effort with a significant report recently and some proposals which will be considered in important consequences in the next administration. The choices that are also on the table that you may want to think about, one has been the notion of the SEC to place less reliance on credit ratings. And before we go there, we have to think through very carefully what happens then. That will mean more reliance, in effect, on those who provide information to the marketplace and not having any outside evaluation. Second, the notion of the government being engaged in credit rating strikes me as not a thoughtful or appropriate one, for the same reasons that we rejected merit regulation in the 1930s in the securities industry.
Dr. Stiglitz, could you add on this?
Yes, I think that it is a very difficult problem, that the current system is flawed not only in the incentives that it provides, that underlies the way the credit rating agencies works, but they were also very much taken up with the same flawed models that the banks were using, and so it was partly their incentives, it was partly their analytic frameworks. I think there needs to be diversity, and we, in other areas like the FDA, rely on governments to rate products to see whether they are safe enough, medical products to safe enough to be used, and circumstances in which they can be used. It seems to me that that analogy is appropriate for financial products as well.
Thank you very much. We're on time here. Congressman Hensarling?
Thank you, Madam Chair. Professor Schiller, your book on the subprime solution is one of 6 presently sitting on my desk. I haven't read it yet. Look forward to reading it. At least you made a few bucks off of me. I think I heard in your testimony, I think you said that you advocate federal subsidies of financial literacy, and I certainly share your enthusiasm for the broader subject of promoting financial literacy within our country. I probably prefer the incentive structure as opposed to the subsidy structure. But I ask the question, as there are various policy proposals pending within Congress that some would argue would essentially bail out a huge universe of borrowers who may not have known about the mortgage products that they signed up for. Maybe they should have known. But what incentive do they have to become financially literate if we essentially absolve them of personal responsibility?
Well, I think we are going through a national tragedy right now of foreclosures. And in many cases, these people didn't know what they were getting into. And so I think that part of our civil society is that we have to bail out many of these people. But I think that it's really important at this time to think about the longer term and think about how we can change the system. Right now, we have a system in which most people get no financial advice from a disinterested party. They get advice from salespeople of one sort or another who have an incentive to sell them their product. What I would like to see is a system in which people are getting advice from someone who signs a statement of loyalty to the client and announces that he or she will not take commissions or kickbacks of any form, and that this would be a long-term relationship a person could develop, like with a physician, but with a financial advisor. You could go to this person and say, should I really take this mortgage? Is this really good for me? And that's something that is a costly thing. I think the government should subsidize it, and that it would ultimately improve the whole atmosphere of the
Well, and again, I share your enthusiasm for financial literacy, and I certainly can't do the quote justice, but I know Thomas Jefferson at one time said something along the lines of, if you disagree how your neighbor is acting within the marketplace, we shouldn't try to restrict his freedom, we should inform his discretion. So I certainly agree with that, but it seems to me when it comes to financial literacy, there would be no greater course than actually having foreclosure proceedings initiated against you, and yet we know that even those who are having their mortgages reworked under various programs, the repeat rate of default, I believe, and I don't have the statistic at my fingertip, is somewhere in the neighborhood of 40%. So that's still somewhat question. I'm not sure there could have been a more effective course in financial literacy than that. If I could, let me change subjects here. Mr. Wallison, in your testimony, I don't think we've touched upon this subject previously, and that is the subject of mark-to-market. I certainly, again, as a philosophical and principled position, believe that more transparency is better than less transparency. I think the opaque quality of a number of these very complicated investment vehicles have exacerbated our problem, but how do you mark something to market when there isn't a market? And is it the accounting rule itself that's the problem, or is it really the intersection of mark-to-market with certain of our regulatory capital standards?
Well, Congressman, it's both in a way. The reason I mentioned mark-to-market in my prepared remarks is that the problem we have today is that fair value accounting is both a problem when there is no market, but it's also a problem when there is a market. It's highly pro-cyclical, and that is that when asset values are going up, it is possible to write up your assets and look much more profitable, borrow that much more money, and increase the bubble that is developing. On the way down, when everyone is panicked and running for the doors and doesn't want to buy anything, then fair value accounting works in the opposite direction.
In the 5 seconds I have left, what would be your proposal?
Well, I think we ought to modify fair value accounting so that it tends to be counter-cyclical. That is, when assets are going up, it should not allow increases in asset values on balance sheets, and when asset values are falling, when there's a panic going on, we should limit the degree to which they can be written down or have to be written down, or allow institutions to treat these assets as held to maturity, which is a much safer way to value these assets.
Thank you.
Thank you. Mr. Silvers?
Could I just add one point that may be relevant to
President
that question?
Seligman.
You may want to take a look at a very recently released SEC Office of Chief Accountant report on fair value accounting, which does focus on impairment issues, actually somewhat similar to some of the points that Peter Wallison just made.
Thank you. Good. Thank you, President Seligman. Mr. Silvers?
Thank you, Madam Chair. There have been several comments made in the written testimony, and I believe this morning, by panelists about the issue of incentives, and particularly in relationship to executives of institutions that are, quote, systemically significant, where there may be a public guarantee of some sort sitting around. I'd be curious to know, I'm familiar with recommendations from the Aspen Institute on both time horizons and symmetry, avoiding asymmetry in compensation. I would hope the panel might comment for a moment, starting with Professor Seligman, on both, are these good ideas, and two, how would one implement them in a regulatory and tax structure?
I'm not clear precisely what the specific recommendations you're referring to. If you want to focus on executive compensation, which...
I'm interested in executive compensation not as an issue of incentives, as an issue of incentives around time horizons and around asymmetries, meaning the incentive to take large risks if you're not fully exposed to the downside.
Yeah. I mean, we have seen throughout the 1990s and into the 21st century clear problems with respect to executive compensation, ranging from the initial treatment of stock options some 15, 16 years ago. The backdating of options has been a scandal, and it's being referred to in a number of enforcement cases, but it got way out of hand. Disclosure and the ability of shareholders to understand what compensation levels are is a perennial challenge. And there has been proposals, including by the President-elect, that there should be at least advisory votes on the part of shareholders to address this area. It's one that requires attention. It's one that I think should be clearly on the priority list for the SEC as it comes into its new administration.
Yeah, I think it's very clear from any analytic perspective that the incentive structures that are commonplace do encourage short-sighted and excessive risk-taking behaviors. I think it is easy to, for instance, base pay not on performance in 1 year, but on performance over a longer time. Making a longer-term horizon would be a relatively easy change. Again, the asymmetries also could be changed. For any highly leveraged, systemically important, it seems to me that would be relatively easy. Let me just emphasize one more point, which is that when that pay is related to stock performance, it has a further effect of encouraging bad accounting standards. And that was what we saw in Enron. It was not fixed in Sarbanes-Oxley, and that so that the problems go deeper in that these incentive systems actually encourage bad information, distorted information, which really undermines the transparency, efficiency, and confidence in our economy.
Thank you. Secondly, the panel, much of the testimony we've heard this morning has talked about regulatory gaps. I would like panelists to react to the proposition that we ought to regulate activity based on what it is economically, and that we ought to have transparency requirements, accountability requirements, and capital requirements in relation to that activity based on what it is. If it's insurance and we call it a credit default swap, perhaps we ought to regulate it like insurance. Comments?
You know, I thought the point of the GAO report makes sense. Start with what are your objectives? Mm-hmm. And if part of it is systemic risk avoidance and reduction, right, then the gaps are seen in a particular perspective where you simply can't afford to have large, hidden aspects of our economy, whether it's credit default swaps or other aspects of OTC derivatives, hedge funds, or what have you. And that strikes me as one way in which you get at this. A second issue, though, is almost the behavioral arbitrage issue. That is, if you say, in effect, if you're a hedge fund manager, you're unregulated, but if you're an investment advisor, you're regulated by the SEC, you create an incentive structure to move towards the unregulated segment of the economy, and you frankly frustrate the ability for examination and understanding of what's going on. I suspect, though I do not know for sure, that when the ultimate books are written on Bernie Madoff, you will discover that most of his activity took place not in his registered broker-dealer operations, but in, quote, exempt investment advisor or hedge fund operations. And in effect, this was an example of behavioral arbitrage, where you had someone move to unregulated areas, and we saw in retrospect a very large price was paid.
Thank you. Senator Sununu? Thank you, President Seligman. I know that you have a plane to catch. We appreciate your being here, and you are excused.
Mr. Silvers, if you could just email me on how I can follow up on the question. Okay.
Thank you.
Mr. Wallison, you talked about devising regulation that was counter-cyclical, and you mentioned the requirements or rules regarding accounting for assets as an example. Could you give a few other examples of recommendations that you would make that you think could be implemented realistically in the next few months that would also reinforce this counter-cyclical approach to regulation?
I think the central problem of pro-cyclicality is a human nature problem. And that is that we are always very euphoric when things are getting better, asset prices are going up. We then become very, very negative when things reverse and asset prices are going down. And regulators are going to be subject to the same problem, and that is when things are looking good, they are not going to stop the party, even though that is the cliche that people have talked about, taking the punch bowl away. They will not stop the party. Congress doesn't want them to stop the party. What we should have is a law that requires the regulators to add capital, requires the regulators to require the regulated institutions to add capital at a time when asset prices are going up, when things look very good. It's kind of a counter-cyclical capital requirement, not the kind of capital requirement we have in prompt corrective action that the FDIC enforces for banks, where they put in increasing institutional restrictions as capital declines. But this would be increasing capital requirements as the institutions are more profitable, because we know that at some point in the future, things will reverse, the bubble will burst, and we are going to be faced with institutions not having enough capital.
Would you interpret the risk-weighted capital approach of Basel II as being pro-cyclical in this regard?
You know, there are so many things wrong with Basel II.
I only have I've got 2.5 minutes here, so
yeah.
No, that's fine. Then we can talk about that later, develop some comments for the record. Mr. Summerlin, you talked about capital standards and having them binding, having them clearer, less subject to subjective interpretation. Can you expand on that a little bit? Talk about what kind of a system for setting capital ratios would make sense, what kind of changes we need to make, and whether those capital ratios should be based on institutional activity or size or other parameters.
I mean, part of how I look at this is I look at what regulations do I think worked, and I think the leverage ratio of the FDIC was helpful. It would work in a similar way to what Mr. Wallison described, where if during good times you wanted to buy a lot more assets, you'd be having to put in more capital. And, you know, my preference for regulation is I like it to be blunt, simple, enforceable, and to be a sort of a backstop. And so that you don't discourage sort of the types of new innovation that Mr. Schiller is talking about, but there is something there that catches you and say, no, you don't get to lever up 50 to 1. And that's, you know, why I sort of like this very simple leverage ratio, just because I think it did prevent, you know, what might have been broader problems during a bubble. If I could just make one more point on the mark-to-market idea. You know, my own view is there is a price for everything, and that price sometimes might be zero, and you might not like it, but there is a price. Now, with mark-to-market, I think one of the problems with it is it's a point estimate, and so I would favor some sort of lengthening a time where you're averaging prices over a longer period, and that would smooth out in both sort of the upside and the downside. And if you look at even quarterly accounting right now, what happens, you know, when a bank has to report its quarterly earnings, it will expand its activities in between the quarter, and then they got to get the balance sheet down, get the balance sheet down, get the balance sheet down for the report. And so we do need to get away from sort of the snapshot in time type of limit.
Let me ask you one question about a statistic I think you used in your testimony, but it came as a shock to me, even having looked at a lot of this material, and that was that in 2005, 43% of the people in America who purchased a home with a mortgage put no money down.
43% of first-time home buyers.
In 2005, 43% of all first-time home
buyers
put no money down.
Yes.
To the best of your knowledge, did any state or federal regulators anywhere have prohibit that, or try to create a regulation that might have discouraged that kind of behavior, which I think most people would fairly describe as somewhat speculative?
I'm not aware, but there's nothing that worked. I'll put it that way. And
Mrs. Raskin, do you know of any states that might have restricted that kind of?
I just want to make this very short.
I wanted to give her a chance to respond. She might have a better information than Mr. Summerlin.
Clearly, that practice has all but evaporated, truth be told. The good thing, I think, is that a lot of states have now passed laws that prohibit what are called stated income loans, loans in which there is no documentation at all provided and there's no basis upon which the borrower has shown an ability to repay.
Thank you. Mr. Neiman?
Thank you.
You need your mic on.
Dr. Stiglitz, in your testimony, you talk about the idea of ring fencing to put greater standards in place for systemically significant institutions and commercial banks that serve consumers and pension funds, and separating those out from business activities that serve high net worth and capital markets activities. Can we draw such a bright line? Is it practical? And I'd like you to just kind of elaborate on how that would actually be implemented or deployed.
Well, it can't be perfectly implemented, but I think it's absolutely necessary that we do something along those lines, because we can't be fully comprehensive in our regulation. I mean, our financial markets are too complex. On the other hand, we know that we have to have far better regulation of our commercial banks, of our systemically important. If we don't, the system will have another crisis such as the one we have. So we have to move towards some degree of ring fencing. We do, in a way, do that already. That is to say, we don't want our banks to invest too much in a gambling institution or something like that. The question is, can we go further? And I think the answer is clearly yes. If we have an unregulated, highly leveraged institution like a hedge fund operating out of a secret bank account, we should say, no, the banks should not be lending to those kinds of institutions which are supportive of corruption or in other kinds of activities. So this is a matter of degree, but I think we can work much more towards ring fencing these core financial institutions.
Thank you. Mr. Wallison, you've written a lot about the role that CRA and the GSEs have played in contributing to the crisis, and as you probably would not be surprised, I come at it that the CRA was not a contributor, and the data that I have seen in terms of origination showed the majority of those originations came from non-bank entities who were not subject to CRA. Have you seen or are relying on data that would support your basis of the role that CRA played in contributing?
The role that CRA played in contributing was simply a role in reducing the quality of the mortgages. That's why we got to the point where Mark Summerlin was mentioning that 43% of the people who bought homes initially in 2005 had no down payment. The purpose of CRA was to force banks to make loans to people who could not otherwise get mortgages. I believe that we should have a home ownership policy, and we do in this country, and it might require subsidies, But in the case of CRA, it just required banks to make loans they wouldn't have otherwise made, and that forced them to reduce the quality of the mortgages. It's the only way they can do it. And so when that began with CRA, it then continued through the rest of the economy. It was picked up by all kinds of other people who were making loans, unregulated lenders as they are called, and Fannie and Freddie bought many of those loans, over $1 trillion of those loans. $1.6 trillion of these bad loans are on Fannie and Freddie's balance sheet. It is not CRA. $1.6 trillion of subprime and Alt-A mortgages are on Fannie Mae and Freddie Mac's balance sheets. Subprime and Alt-A, that's right.
These are not originations, though. This is including the amount that they were required to buy later on. Is that right?
Yeah, they have. They were required by their affordable housing regulations to buy.
No, not by the regulations, but have been required by Congress to purchase.
Well, through the affordable housing regulations, Congress did not insist on they.
No, not through originations. That's the question I'm asking about trying to sort this out. At least, I'm sorry.
Right.
Mr. Neiman.
No, and I was getting at
that afterward, but my whole point is simply that CRA did not add materially to the number of such mortgages. They were very small, about 3%. What CRA did was start the process of making mortgages of lower quality, and that's the central problem we have today. It is true that we've had a big inflationary bubble because perhaps of the interest rates that the Federal Reserve approved for a long period of time. But what's different about this bubble is that the mortgages that are causing problems are very poor quality mortgages. Otherwise, we wouldn't have this financial crisis.
Yeah, just to follow up with one
Since
minute.
I used your time.
Thanks. You know, the way we've seen it operating throughout neighborhoods throughout the country is so much of that was originated by non-bank entities, not subject to CRA. But I'm not making any apologies for the large commercial banks and investment banks who were funded that through the securitization process. But it was not CRA that was driving that. It was the securitization process and the misaligned incentives and over-reliance on credit agencies.
And Fannie and Freddie bought them.
And I think I'll conclude my...
I want to thank you all for being here. I have special thanks that I need to acknowledge publicly to the Senate Committee on Commerce, Science, and Transportation for lending us this lovely room for our hearing. But I especially want to thank all of our witnesses for coming. Mrs. Raskin, Dr. Schiller, Dr. Stieglitz, Mr. Summerlin, and Mr. Wallace. And we appreciate your taking the time to prepare your testimony, to come here. And I hope you will be willing to answer questions that the panel submits in writing and have those questions be on the record. We appreciate your help very much. And with that, this hearing is adjourned.